Time in the market versus timing the market. It's the oldest debate in investing. But what if there's a third option? What if waiting for a crash is the smartest move you can make? Today, we aren't guessing. We are looking at 100 years of S&P 500 data, back to 1926. We're testing 4 distinct strategies across 82 different 20-year periods, investing $40,000 each time. The question is simple: does waiting for a crash actually work, or is it a surefire way to fail? Here are our contenders. First, the lump sum investor. They deploy all their cash on day one and leave it for 20 years. Second, the crash buyer. This is the tactical investor. They wait for drawdowns, deploying cash in stages as the market drops 10, 15, 20 and up to 30%. Third, DCA monthly, the classic dollar cost averaging approach, splitting the investment over a year to reduce timing risk. And finally, the peak buyer. This is our control group, the worst case scenario where you accidentally buy at the absolute highest price of the year. Let's look at the raw results. Across 82 periods, the winner is clear. Lump sum investing takes the crown with a median final value of over $154,000. DCA comes in a close second. But look at the bottom. The crash buyer strategy? It finishes nearly last, practically tied with the peak buyer who bought at the worst possible time. At first glance, it looks like trying to buy the dip is a losing game. But is the whole story that simple? Is lump sum investing just lucky? Not exactly. Lump sum wins 51% of the time and has never finished in last place. That is a structural advantage, not luck. The market trends up over time. But look at DCA, it's the reliability champion. It never finishes last. Now look at the crash buyer. It has a 33% win rate, which sounds okay, but it finishes last 28% of the time. Why? Because while you're waiting for a crash that might not come, your cash is sitting there earning 0%. That opportunity cost is brutal in a bull market. But here is where the data gets interesting. We've been ignoring one massive variable: valuation. Specifically, the KP ratio. When we split the data by how expensive the market was at the start, a pattern emerges. If you start when the market is very cheap, a CAPE under 10, your median return is a massive $323,000. But if you start when the market is very rich, a CAPE over 25, that median return plummets. Valuation isn't just a detail, it's the blind spot that changes everything. So, let's ask the critical question: what happens when you invest a lump sum when the market is historically expensive? The results flip. In periods starting with a KP over 25, the lump sum median drops to $121,000. But the crash buyer? Their median jumps to $135,000. In these expensive environments, the crash buyer actually beats the lump sum investor 64% of the time. Suddenly, waiting for a dip doesn't look like a failure. This chart tells the whole story. Look at the green bars for lump sum. When the market is cheap, CAPE under 10, lump sum dominates with a 60% win rate. But as valuations get expensive, that win rate collapses. Meanwhile, the orange bars for the crash buyers start to rise. There is a crossover point around a CAPE of 20. Once the market gets expensive, the crash buyer overtakes lump sum as the #1 strategy. Blindly buying the dip is bad, but blindly buying anything when valuations are sky high is worse. So, can you just pick one strategy and stick to it forever? The honest answer from 100 years of data is no. If you blindly lump sum, you leave money on the table 64% of the time when markets are expensive. If you blindly crash buy, you get punished by opportunity cost during long bull runs. DCA is the closest thing to blind safe. The real edge isn't the strategy itself alone, but a combination with valuation awareness. Every strategy is a trade-off. Lump sum offers the highest median return but requires you to have full exposure on day one, even if the market crashes tomorrow. The crash buyer offers upside in crashes but suffers a brutal 28% last place rate overall. DCA smooths out the entry price but drags on performance due to cash drag. There is no free lunch. You are either paying for reliability with lower returns, or paying for higher returns with higher risk. Here are your key takeaways. Number 1, time in the market mostly beats timing the market. Number 2, DCA is the safest default, but not the most profitable. Number 3, valuation matters. CAPE changes the game. At low CAPE, lump sum dominates. At high CAPE, crash buying wins. Number 4, crash buying requires conviction and patience. You will miss out on rallies. And finally, number 5, no single strategy wins blindly across all conditions. Adapting to the environment is the only true edge. Remember, this video is for educational purposes only. Past performance of the S&P 500 does not guarantee future results. Investing involves risk, including the loss of principal. Always consult a qualified financial advisor before making investment decisions. Thanks for watching. You've just seen how we're turning data into wealth. If you want more insights like this, subscribe to the channel. Hit the like button, share and comment below to discuss what similar videos you'd like to see next.